Ladies and gentlemen, good day and welcome to Cera Sanitaryware Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Devrishi Singh from CDR India. Thank you, and over to you, Mr. Singh.
Thank you. Good morning, everyone, and thank you for joining us on the earnings conference call for Cera Sanitaryware Limited for Q2 and H1 FY26 earnings, which were announced yesterday. We have with us today the management team comprising Mr. Vikas Kothari, CFO, and Mr. Deepak Chaudhary, VP Finance and Investor Relations of Cera Sanitaryware. We will start with brief opening remarks from the management, following which we will open the call for Q&A. A quick disclaimer before we begin. Some of the statements made in today's conference call may be forward-looking in nature, and a detailed note in this regard is contained in the results documents that have been shared with all of you earlier. I will now turn the call over to the management for their opening remarks. Thank you, and over to you, Deepak.
Thank you, Devrishi. Good morning, everyone. On behalf of the management team of Cera Sanitaryware Limited, I would like to extend a warm welcome to all of you to our Q2 FY26 earnings conference call. I will begin by sharing a brief update on our operational and strategic progress, following which our CFO, Mr. Vikas Kothari, will take you through the financial highlights for the quarter. In the backdrop of demand environment that remains subdued, particularly on the retail side, we are pleased to report a steady performance this quarter. Our sanitaryware segment delivered a year-on-year growth of 1.4%, supported by stable demand and continued traction in our product portfolio. While the sanitaryware segment continued to face headwinds, the pace of contraction moderated compared to the previous quarters. We believe that improving macro fundamentals and policy measures, including the recent GST changes, will aid recovery in retail demand over time. As indicated in our previous earnings calls, I would like to reiterate that over the past few years, we have continued to strengthen the organization's strategic foundation through sharper brand segmentation, differentiated channel strategies, and a focused innovation agenda. These initiatives are already enhancing our market readiness and execution agility. We believe that as the demand cycle turns upward, these efforts will translate into meaningful growth momentum across the business. Our B2B segment continued to demonstrate healthy traction during the quarter, supported by steady order inflows from the real estate sector and sustained construction activity. Project sales accounted for 39% of our top line in Q2 FY26. We continue to benefit from a strong brand equity, execution reliability, and deep relationships across the developer ecosystem, which are enabling us to participate in larger and more complex projects. This remains an important growth pillar for us and helps balance the current softness in retail demand. Another important initiative during the quarter was the rollout of a dealer management system, which marks a major step in strengthening our distribution network and improving data visibility. We have successfully onboarded about over 200 dealers so far, with system integration and data connectors now activated at their end. Since each dealer operates on a different platform, achieving this level of alignment has been a challenging task, and we are proud to have made strong progress on this front. The DMS gives us better visibility into secondary sales, dealer-wise inventory, and retail coverage, information that was earlier not available in real time. This enhanced visibility will improve accountability, track market movement more closely, and support faster and more informed decision-making. Over time, the system will also aid better demand planning and channel management. We plan to extend DMS coverage to more dealers in the coming quarters. On the strategic front, our premium brand Senator and recently launched Poly Plus continue to make encouraging progress. On Senator, we remain firmly on track to achieve our FY26 flagship rollout target of 45 to 50 stores, with 28 stores already operational as on date. The format and positioning are designed to create a more immersive brand experience, backed by an expanded product range, a dedicated dealer network, and a focused engagement model. Over the past few months, we have strengthened the team structure, bringing on board experienced professionals across sales, business development, and brand activation to drive the execution at scale. On Poly Plus, we have ramped up our efforts on Poly Plus, our differentiated offering aimed at deep value segment, where the unorganized market still holds significant share. The team build-out is nearly complete, and we have initiated targeted on-ground activations and promotional campaigns to establish brand presence in key Tier 3 and Tier 4 markets. At present, Poly Plus is being distributed through 38 distributors and 650 dealers, with a target to expand the network to 100 distributors and 2,000 dealers by March 2026. The early response for both the brands has been encouraging, validating our approach of segmentation of the portfolio to address distinct consumer and channel opportunities. In the quarters ahead, we will continue to expand distribution reach, enhance market visibility, and build on this early momentum. Innovation and new product development remain core to our strategy. During the quarter, new product launches contributed about 33% of the overall sales, reflecting our continued focus on keeping the portfolio contemporary and relevant. On our new designs are developed through regular market feedback and are designed to trend, aligning with evolving consumer preferences and emerging style themes. We will continue to strengthen our design and innovation pipeline to ensure sustained differentiation across categories. By strengthening our brand segmentation and aligning products and channels with different customer segments, we are expanding our market reach while maintaining clear focus across categories. This approach, which covers a wide range of price points and regions, gives us flexibility to manage short-term challenges while staying focused on our core values of quality, innovation, and customer trust. These ongoing efforts are building a solid foundation for future growth as market conditions improve. While the exact timing of a broad-based retail recovery is still evolving, we remain optimistic about the long-term growth trajectory of the industry. Structural drivers such as continued formalization, rising consumer aspirations, urban redevelopment, and housing programs, and sanitation initiatives remain intact. Alongside these, policy measures such as the recent GST changes should aid sentiment and activity over time. Taken together with our brand strength and distribution reach, we believe the category remains well placed for steady expansion. We continue to invest in brands, distribution, and product innovation to stay ahead of evolving consumer needs while maintaining firm cost discipline. The benefits of ongoing cost optimization initiatives and operational efficiencies are visible in strengthening of our ability to sustain margins in a mixed demand environment. Furthermore, during the quarter, we completed the exit from two of our LLPs, Race Polymer Arts LLP and Packard Packaging LLP, effective from 29th of September of this year, thereby streamlining our portfolio and sharpening our focus on core categories. With the divestment in these two entities, Cera does not have any subsidiaries and hence will report numbers on a standalone basis only henceforth. To conclude, Q2 FY26 underscores stable execution in a soft retail environment, coupled with steady traction in project sales and encouraging strategic progress. As we move into the second half of the year, we remain cautiously optimistic about improving demand trends and confident in our ability to respond with speed and scale. Our ongoing investments in brand architecture, channel segmentation, and new market development, supported by strong internal capabilities, are building a robust platform for sustained growth. We remain focused on disciplined execution, enhancing consumer engagement, and creating enduring value for all stakeholders. With this, I would like to hand over to Mr. Vikas Kothari, our CFO, who will present the operational and financial highlights for the quarter ended 30th September 2025. Thank you, and over to you, Mr. Kothari.
Thank you, Deepak, and a very good morning to everyone. I will now take you through a brief overview of the company's financial performance for the quarter and half year ended 30th September 25. Revenue from operations for Q2 FY26 stood at rupees 488 crores, remaining largely flat compared to 490 crores in Q2 FY25. EBITDA without other income was at rupees 67 crore as compared to the corresponding quarter of the previous year at rupees 70 crore. EBITDA margin slightly declined from 14.2% in Q2 FY25 to 13.8% in Q2 FY26, primarily due to increase in input costs. However, the said impact is partially mitigated by improved operational efficiency and cost optimization program. Gas costs witnessed a slight decrease during the quarter, with the weighted average cost standing at rupees 33.79 per cubic meter in Q2 FY26 compared to rupees 33.95 per cubic meter in Q2 FY25. Our costs remain well below the industry average, reflecting the benefit of our balanced sourcing strategy and operational efficiencies. During the quarter, gas consumption was sourced 80% from GAIL and 20% from Sabarmati. Overall, gas costs as percentage to revenue stood at 3.6%. For the quarter under review, revenue contributions by segment were as under. Sanitaryware at 47%, faucetware at 40%, tiles at 11%, and wellness at 2%. On a YOY basis, sanitaryware revenue grew by 1.4%, tiles by 3.1%, wellness by 3.2%, while faucetware revenues declined by 3.5%. Revenue from faucetware segment appears lower YOY, mainly due to the high base of the previous period, which was driven by the price increase implemented then. With no price revision taken in the current financial year, sales volume have remained healthy and the apparent decline reflects the base effect rather than any weakness in the underlying demand. Our core categories, sanitaryware and faucetware together, accounted for 87% of the total revenues. On the capacity utilization front, capacity utilization stood at 85% for sanitaryware and 97% for faucetware during the quarter under review. In terms of product positioning, 42% of our sales came from premium category, 36% from mid segment, and 22% from entry-level products. From a geographical standpoint, Tier 3 cities led with 41% of sales, followed by Tier 1 at 36% and Tier 2 at 23%. Profit after tax stood at rupees 57 crores as compared to previous year's quarter at rupees 68 crores. The profit after tax appears lower mainly due to deferred tax income recognized in the previous year arising from a change in the capital gain tax rate on long-term investments. The current year's figures reflect normal operations without this one-time tax impact. Earnings per share for the quarter was at rupees 43.92 compared to rupees 52.44 in Q2 FY25. In terms of the working capital management, inventory days increased from 80 to 83 days, receivables raised from 31 to 33 days, while payable days remained stable at 39 days, leading to a YOY increase in net working capital days from 72 to 77 days. For the half year under review, the company reported net revenues of rupees 907 crores, an increase of 2.2% as compared to H1 FY25. EBITDA without other income was at rupees 120 crores, a decrease from rupees 126 crores in H1 FY25, and the profit after tax reported at rupees 103 crores, a decrease from rupees 115 crores in H1 FY25. As of 30th September 25, our cash and cash equivalents stood at rupees 736 crores. For financial year 26, we have earmarked a capex outlay of around rupees 23 crores. This primarily covers the routine maintenance requirements along with focused investments to strengthen our brand presence and expand our retail footprint. Our capital allocation approach continues to remain prudent and aligned with our long-term strategic priorities, ensuring that every rupee is deployed with clear visibility on returns and long-term value creation. We remain confident in Cera's financial resilience and its ability to deliver sustainable performance through cycles, supported by a healthy balance sheet, continued focus on operational efficiency, and prudent working capital management. We are well placed to navigate the current environment with agility. Our disciplined capital allocation and cost optimization initiatives provides us with the flexibility to invest in strategic priorities and capitalize on emerging opportunities as the demand environment improves. With this, I would now request the moderator to open the line for Q&A. Thank you very much.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Archana Gude with IDBI Capital. Please go ahead.
Hi. So thank you for the opportunity and congrats on sequential improved earnings. I have three questions. Firstly, on the full year FY26 earnings, in the last earnings call, you guided higher single-digit sales growth, and given we have grown just 2% in H1 of FY26, is the net sales growth of 13-14% is doable in H2 FY26, or will have to rework on the growth guidance, both on top line as well as operating margin front? That's my first question, sir.
We continue to be optimistic about the H2 performance. Like we have done 2% in the H1, and we anticipate that H2 will be improving with all the macroeconomic factors being positive. So we anticipate that we should be ending H2 with something like 10 to 12% of a growth number. So that for the full year, we should end up at something like 7 to 8% growth for the full year.
Sure, sir. But then that also means we need to slightly reduce our operating margin guidance also.
Operating margin should be remaining at that region of 14.5% to 15% that we're seeing right now. Typically, because the numbers are smaller in the first half, you'll find that operating margins are also slightly lower. Once the numbers improve in H2, which is typically higher than H1 by typically it is 45% in the first half and 55% of our total sales comes in the second half. So with improved volumes, the margins automatically improve in the quarter 3 and quarter 4. So we should continue to maintain margins in the range of 14.5% to 15%.
Sure, sir. So you spoke about capitalizing on this emerging micro demand tailwind. So can you help us understand it better in terms of any particular product segment is witnessing higher demand, or is there any specific regional level revival? Also, how has been the performance in October and early November this month?
So as far as the macro factors are concerned, so the whatever the numbers, what we have told, or the initial expectation, what we have given in H1, that remains conditional on the recovery in the end market demand. So, but we see very positive signs in macro environment, like the interest rates are stable, steady GDP growth is there, increased government spending on housing and infrastructure, and the recent rollout of GST 2.0, which simplifies the tax framework. So overall, all these factors encourage us in terms of improved H2, like Deepak told, and our understanding is that we will be able to reach out to the numbers, but we remain cautiously optimistic of the demand recovery, what we stated, that it will happen in H2 FY26.
Sure, sir. So in fact, this October and November, we saw some green shoots in demand, or it was like still okayish and we need to give some more time to see the actual recovery?
So just to give you an overview, what we have seen is, over the past several quarters, we have seen that the demand is sluggish across all the categories. But what we have seen in the H1 or the late start of H1, the sanitaryware segment in our case, which was almost muted, or in some quarters it was degrowing, that degrowth has been arrested. And this for the last 2 quarters, if you have seen, we have in this quarter, I think we have grown by 1.4%, and faucetware is growing at a good speed, except this quarter, which was just a one-time adjustment in terms of the price rise what we have taken last year. So faucetware again is growing at a speed of 8 to 10%. So our understanding is that the growth which is going to be there, it will come in H2, and we will definitely be able to see the better months coming in the H2.
Sure, so that was pretty helpful. Thank you so much and all the best, sir.
Thank you. Next question comes from the line of Praveen Sahai with PL Capital. Please go ahead.
Sir, my first question is related to the divestment. So in the press release, you had mentioned that the divestment, you have received a consideration of around 18.7 crore. So is that booked in the P&L in the Q2 or yet to?
Yeah. So, Praveen, thank you very much for asking the question. Just to update, as we have already given you our financials also, the company has divested its stake in its 2 subsidiary LLPs, that is Race Polymers Arts LLP and Packard Packaging LLP. This is owing to their relatively lower business magnitude and limited strategic lines, and with respect to the focus what we want to develop in our core business activities. So that was the event which has occurred in Q2, before the closure of Q2. And regarding the deal which has been done, so the total consideration what we have received of these 2 LLPs is, what you have rightly told, is 18.75 crores. and we have the profit of on sale of on divestment of 5.54 crores, which forms part of this Q2 and is in other income. Sorry.
Okay. Thank you for that. Second question is related to your guidance of a 7 to 8% of a growth on the overall side. You also mentioned that the retail is a bit slow, and to offset that, you are entering in the project business. Now it's at 39% contribution from the project business. So the way forward in the later in the year, we will see this contribution to increase further to bring the growth.
Praveen, it is really difficult to say because as to whether the project size would, as a proportion of the total business, would be growing or not. Essentially, that is totally dependent upon how the demand revives. If retail improves, then obviously this proportion will remain same and then over a period of time steadily decline to the levels that we anticipate of 35%. But if that sluggishness continues, then obviously this proportion will most probably remain at this level or maybe again go up slightly. But that will totally depend upon the kind of growth which happens in retail. In the shorter term, let's say for the H2 kind of the numbers that we are seeing, we are kind of thinking that it should remain at the current levels, at the level of 40%, because we have started seeing green shoots in the retail environment also. So we anticipate that it should be remaining in the level of 39-40% for the current year ending March 26.
Okay. Secondly, on the brands, Senator and Polyplus. So, is there any contribution so far from these two brands in our numbers?
Currently, it is more about the setting up of the team, setting up of the distribution channel, getting the products in place. So, as of now, there are no significant numbers. The costs have started coming in, but the sales will be starting in Q3 and Q4. We anticipate that we should be ending the year with both these brands at something in the region of 40 to 45 crores.
Sorry, I missed. How much you said? 40, 45 crores.
Correct. For Senator and Polyplus taken together for the next 2 quarters.
Okay. Good to hear that. Thank you, sir, and all the best.
Thanks.
Thank you. Reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Jasprit Arora with Equentis PMS. Please go ahead.
Yeah, hi. Good morning. Thank you for the opportunity. The segment-wise growth rate that you mentioned, sir, just to clarify, that Sanitaryware 1% growth and faucets -3%, that was for Q2.
Right.
Okay. What would be, sir, for H1, the similar number?
So, if you talk about H1, so in case of H1, Sanitaryware has grown by 0.58%. Faucetware has grown by 3.5%. Wellness has grown by 8.2%, and tiles have grown by roughly 4%. So overall growth in terms of H1 is 2.2%.
So faucets had grown 3%.
Yeah.
3 plus, and despite Q2 being negative. So the first quarter growth was very good.
Yeah. So the you will see the impact in Q3 because, like I told, in case of faucetware, last year's quarter, the price rise impact was taken in case of faucetware because of the rising brass prices. And because of that anticipation, the pre-order bookings were done, resulting into the comparative corresponding growth with their previous quarter was roughly 20%. So that was a one-time impact. But overall, we are quite positive in terms of faucetware demand. So there is a good demand in faucetware. The impact is, if you see, for H1, it is somewhat 3.5%. The growth which was there in Q1 is somewhat offset by this one-time effect. But we are quite positive that by end of year, the numbers which we are saying, roughly 8 to 10% growth in faucetware, that seems appearing.
Okay. So full year we are saying 8 to 10% faucet revenue growth. And
Yeah.
what would be the volume and price mix within this?
The volume and price mix is very difficult to say in case of faucetware, because both in case of sanitaryware as well as faucetware, because it's a completely mixed basket. Basket, and we have a lot of SKUs which are in completely different price ranges. So we'll always go by the in terms of the revenue growth.
But some idea, would it be a large part would be price or large part? Just to get a, I'm sure faucets, I understand sanitaryware is difficult, or even there it, yeah. So if you take like one standard product or whatever, just to get a sense, because volume at the end of the day is a a barometer of how the economy is growing. Price is always secondary. I mean that's not in our hands.
If you look across let's say last 3-4 years, there has been hardly any price increase which has been taken. Last year we had taken a price increase of roughly on an average it was working out to 5.5 to 6% for faucetware. Even that you will find that the price increase takes some time to get implemented because of the fact that it takes for all the projects you'll have prices which are more or less remaining constant for the delivery period, which will be typically something from 1 year to 1.5 years. So projects the rise starts happening only after a certain time lag. In retail also, because the dealers normally you have an effective date, but the pickup starts happening only after some time. So the price increase has been only to the extent of 6% last year. Apart from that, everything what has come, the increases which have coming are coming on account of volume only.
Okay. And we're saying that for the second half, against 2% odd growth in revenue in the first half, in second half we are expecting closer to 12 to 13% revenue growth. Is that what you said? Okay. And just to understand that part, you mentioned there are certain macroeconomic factors which will come into play. So what I couldn't understand, what were those macroeconomic factors which were absent in 1H and which will now come into force in 2H?
No, so like I talked about, means there is a freeze as far as discretionary spending with respect to consumer was concerned.
There is a freeze.
Means
slowdown. You mean a slowdown?
Hello.
Yeah, you mean there is a slowdown in discretionary spending?
Yeah. So with all the positive signs which are coming, like the interest rates are stable. We see that a lot of spendings are happening on from the side of government also, and all these factors what we are saying that will help us in terms of changing the mindset of the consumer in terms of whatever the decision they have postponed. So they will start initiating those decisions, and this will support the building material industry, including our sanitary and faucet industry also.
Thank you. Mr. Arora, please rejoin the queue for more questions. Next question comes from the line of Resham Mehta with GreenEdge Wealth. Please go ahead.
Yeah, thank you. So just two questions, actually clarifications. Maybe I missed the opening remarks, but you've guided for a 7 to 8% overall top line growth for the full financial year, or is that just for H2?
For the full financial year.
Full financial year. And within that, faucets will grow in double digits. Is that understanding right?
Correct. Yeah.
Got it. And also, you mentioned that the two new brands, Senator and Polyplus, will contribute to 40-45 crores in H2.
Correct.
And, in terms of gross margins, so why did we see a compression in gross margins this quarter?
Gross margins is more or less remaining the same. You'll find that across quarters, there'll always be a variation of 1 or 2%, but otherwise it is always in that range of 52 to 55%. The discounts, typically you'll find that the gross margin function of two things. One is the kind of discounts which is being offered by the company. Second would be the cost of the products that we are selling. So discounts have kind of remained stable over the last couple of quarters, you can say. Vis-a-vis Q1, we have seen that discounts are not going up, they have stabilized. But if you look at in comparison with the previous quarter, you'll find a slight 0.5% kind of a difference between the kind of discounts we offered in Q2 of the previous year as compared to Q2 of the current year. But now that discount trend has been arrested. So there are a lot of factors which go into making that the kind of stock which was being uploaded, the kind of mix which has been sold. So there's a slight variation on a quarterly basis, but the overall basis, you'll find that the gross margin remains constant.
Right. And any input cost inflation?
So regarding the input cost, means largely what we have seen, the brass cost, which has shown the growth last year, and after that it remained within the range of 590 to 600 per kg. So that remains there. But again, when we talk about the current scenario, maybe we are sitting in the month of November. So the metal price, brass price has again taken a sharp increase. It is beyond 600, roughly it is 620 or 30. So that is the one factor which has impacted our the margins also, the profitability also. So that we are cautiously watching in terms of any subsequent rise if we want to take. If the brass price continuously on a rising trend, so that will be taken care of. But we are right now reviewing the market scenarios in terms of the metal market. And with respect to the other prices, other input prices like the clay and the feldspar chemical which is used, so there is a increase in the price versus the Q2 of the last year. So those prices have increased slightly, but largely the focus is with respect to the brass prices. So what we are smartly doing is, with these prices increase which are there, we are more or less improving, offsetting, partially offsetting the impact with our improved operational efficiencies and the ongoing cost optimization initiatives which we are taking across the categories.
But no price hikes being planned, right?
Yeah, it is not planned because I think in the month of October, November, the brass prices have grown drastically. But still, we want to see the pattern. And then if we see there is an impact, because in case of faucetware, almost 60%, 60 to 65% of the cost of the product pertains to the input cost. And if we see the stable trade in terms of the price increase, then we may take a decision. But right now, there is no such plan.
All right. Thank you.
Thank you.
Thank you. Next question comes from the line of Karan Bhatelia with AMSET. Please go ahead.
Hi, am I audible?
Yeah, we can hear you. Yeah, Karan, we can hear you. Please go ahead.
Mr. Bhatelia, please go ahead.
Yeah, with respect to the Senator and the Populous portfolio, while you mentioned that 45-50 crores could be seen in the current year, how do we see next 2-3 years in terms of revenue potential and the scale up in the margin profile as well?
In respect of the margin profile, like Senator will have slightly higher margins as opposed to the kind of mix that we are having right now. We expect that it should have margins to the tune of 20 to 22%. Polyplus, we expect it to be slightly higher. It should be in the range of 25%. The kind of volumes and the numbers that we are expecting in the next 3 years.
Yes.
Just 1 second, I'll just tell you. We are projected for the next 2 years, like this should be contributing to something like 150 crores of turnover from Senator and Polyplus taken together.
Right. And what kind of new product launches we've seen in the core category of Sanitaryware faucet for first half and the expansion in the network?
There has been no new launches in sanitaryware and faucetware because we had quite a few launches in the last couple of years. Our product portfolio has undergone a complete change within the last 2 years. So this year, the launches were mostly in Polyplus and in Senator, where the new products, all the new range has been completely new range has been launched. So for the first half, there were no further launches in your sanitaryware and in faucets.
Okay, sir. Thank you. That's it.
Thank you. Next question comes from the line of Syed Nawaz, an individual investor.
Hello. Thank you for the opportunity. Am I audible?
Yeah, we can hear you.
First of all, good morning, everybody. I have 2 questions in terms of scaling
Mr.
up
Nawaz,
the...
sorry for interfering. Can you, there's a lot of background noise. Can you come in the range and talk as well?
Yes, sir. One second. Hello. Am I audible now?
Yes,
Yeah,
please
much
go.
better.
Great. So I have a few questions about the premium products that we are launching, for specifically the Senator brand and the Polyplus. Since the company is transitioning into the premium market segment, and 42 to 43% is what has been the average contribution towards the overall revenues. How are we expecting to compete in the segment where we have already established players in the sanitaryware segment, first of all? Like we have Interwear and we have some other players as well who specifically cater to the premium category. Or what is the marketing position of the company in the sense that how are we looking forward to capture the market in the premium segment?
Cera has a long standing, like we have been in the premium segment for quite some time. But now we are trying to go level up from the premium segment that we are already present to address the one which is being currently catered to the more the multinational brands. So the idea is to have a completely different kind of a product profile. The kind of products we are having for Senator is very different from what we are currently having our Cera portfolio. So there's an upgradation in the kind of both the aesthetics, the kind of features, and complete different product profile which we're offering for Senator. The kind of experience that will be offered to the consumer would be also very different. For this particular brand, we are targeting a completely new set of dealers, a new set of showroom and a customer experience, which will be very different from what is available for the Cera portfolio. So the idea is to reach a set of consumers, which is not as of now being addressed by the Cera. There's no focus right now for those particular products. So the idea behind Senator is to give a more focused drive on the premium segment.
Any marketing burn or anything, any marketing spends, etc. Because as you said that we are entering into a new segment altogether, which has not yet been explored by Cera. So are we expecting any marketing burn as well?
Like in the first year, like we're talking about, let's say the 2 quarters which have gone by and also the H2, the focus would be mostly on getting the showrooms ready and also more on the acting on the influencers, getting the influencers on board, making them aware about the brand, because they are the ones who kind of bring in the consumer and the final decision tilt happens because of them. So in the first year, it will be mostly focused on getting products and showrooms ready. So the total spend that we intend to do would be carved out of the total budget that we have. We expect it to be in the range of 10 to 12 crores. From next year onwards, you'll find that that amount would increase, both for Senator as well as for the Polyplus also.
And I have another question about the forecasted profits that we have discussed. Or specifically, there's again, it would be a very novice statement to make from my side, but I have observed that there is a reduction in the amount of sales that have been done, and historically, again, at least in 4 or 5 years, we see that there is a slight reduction in the revenue of the company. I have studied the data for the past 10 years. And I just wanted to get a clarity about, are we looking at a sluggish market or at least, a lesser demand in terms of less real estate development projects being undertaken, or what is the exact reason behind the fall in revenue or fall in the general demand of the products?
See, if you look at, as you are mentioning in respect of Cera, we had a good growth, let's say, but till 2 years back, or rather 3 years back, from which the numbers have stagnated. We have been in the region of 1,800 to 1,900 crores over the last 3 years. So, as you mentioned, the demand has been sluggish. It has been especially true for the retail segment over the last, you can say, 7-8 quarters, 2 years. But over a period of time, we have found that our project business has started going traction. The project business which used to constitute something like 30% earlier has now gone up to 39%. And we anticipate that once the retail demand picks up, that growth which has been missing over the last 7-8 quarters should again be back on track.
Thank you. Mr. Nawaz, please rejoin the queue for more questions. A reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Lakshmi Narayan with Tunga Investments. Please go ahead.
Yeah, thank you. Sir, I observed that in the sanitaryware category, the competition is quite high, and we see that an entrant who has been restricted more to faucetware has actually started getting traction in sanitaryware. Now, does that explain some amount of slowness in our growth? That is my first question. Second is that how the realization of sanitaryware has actually improved in the last 1 year or so, and what is an average realization of the sanitaryware for us?
So, like you told, in terms of the entrants or in terms of the players who are dealing in faucetware, they have got an opportunity to come into the sanitaryware segment also. So we have seen from last several quarters that there are new entrants which have entered into the bathware zone. So again, since we are seeing that the market itself is not that much growing because of the sluggishness in the environment which is flowing. But overall, the comment from Cera's side is going to be that Cera, being a brand which is established for more than 4 decades, and the product line, the quality and other things are well established. So brand loyalty and the type of innovation what we used to put in our products, that is going to be more sustainable model. Again, with respect to comparison with the new entrants, so the service differentiation, what we provide in terms of after sale to the consumers and the wide dealer networking what we are having. So that is all going to be the plus point, whereas for the period under review, when we are talking about the demand sluggishness and all, so there is an opportunity they have come. But on a long-term basis, we are quite confident that once the demand pattern will improve, definitely we will be getting our revenues will be improved. What we have projected in terms of the overall growth.
So, just on that one, if I look at some of the housing sales, etc., at least in the premium segment or even in the 50 lakh to 1 lakh, the registrations in top metros continue to grow, and even some of them have actually taken possession also. So I'm just trying to understand what is the correlation one can actually expect between that and our industry growth, because there seems to be some kind of disconnect, though we always know that only towards the end people actually have the sanitaryware, but somehow it is not adding up. Can you just explain me why is this?
What you are saying is correct. Like if you look at the scenario which has happened post-COVID, the growth, traditionally Cera has been there in the premium and the mass premium brand, and the growth over there in those particular markets had been kind of stagnant. We've had quite a new players who have been coming in over there, You also have a segment which has been growing quite well, the premium, the luxury segment, the metro market, where you'll find that a few players have been able to capture that market, where Cera was not having a very strong presence. So that is the idea that we have come out with that brand Senator, which is targeted towards the market, which is as of now showing traction.
Thank you. Mr. Narayan, please rejoin the queue for more questions. Next question comes from the line of Arun Baid with ICICI Securities. Please go ahead.
So just one clarification. You said your margins will be 14.5%, 15%. This is for the full year, right?
Correct, yeah.
Yeah. And second thing is, in the first half of this year, how much money you would have booked in the P&L with regards to Polyplus and Senator because of the for the employees?
In the current half year which has ended, the sales have been marginal because it was more about getting the products and the dealership in place. So the amount of sales in the first quarter is kind of negligible.
No, I'm asking the expense because you guys have like people, branding expense over time. How many would that be?
See, for the kind of showroom development which has happened, it's an ongoing thing. The cash outflow happens, but the actual expenditure comes in by way of depreciation, which will be happening over the next, you can say, few quarters. In terms of branding, there would have been some expense. We have not initially categorized it specifically for Senator what amount has been spent. The main impact would be on the people front, where we anticipate that for these two brands taken together, we would be having an annualized expenditure of something like 15 crores. We can say 14 to 15 crores for the full year. So the team development had started. So a part of that expenditure would have been the main expense which would have gone into Senator and Polyplus.
So roughly the first half, would it be right to assume that you would have spent, I'm talking about the employee expense only, around 5 to 7 crores? Would it be right assumption for the first half?
It will be in the range of 5 crores.
Okay. And second thing is you mentioned that 150 crores is what you budget from these two brands. This is by FY27?
Correct, FY27.
Okay. Thank you very much.
Yeah.
Thank you. Next question comes from the line of Jaspreet Arora with Equentis PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity again. Just to clarify, sir, you mentioned this extra income or a one-off income of 5.5 crores. So the PBT of 72 would become whatever lesser by that much, right? 66, 67 crores. Is that how to read it? The recurring PBT?
The EBITDA without other income is in the range of 67 crores as opposed to 69.60 crores in the previous corresponding quarter.
And the PBT of 72 crores includes this 5.5 crores of exceptional income.
5.5 crores. Correct.
Yeah, it's with other income. Correct.
Okay, that helps. And just lastly, are there any measures within the cost side, in particular, maybe on the fixed side? I understand variable is not, on the variable side might be difficult. There's already inflation and price increase difficult. So on the cost side, because other building material companies are, doing enough incrementally, on the cost side, on the fixed cost side, whether it is salaries or overheads. Do you have any scope of any adjustments there to ensure that the margins do not dip beyond a point?
This is a continuous exercise. Like over the last 8 quarters where we have not witnessed an increase in revenue, the top line has not been growing. You find that the kind of margins that we've been able to maintain has been primarily because of the fact of that we have undertaken a continuous basis cost optimization program. That is across the functions, across all categories, across all functions. So other players may have started doing it now, and that is why.
No, any specific areas you can highlight? Sorry to cut. Any specific areas you want to highlight and also give the impact, because this is a little bit generic what you're saying, which we appreciate, but quantum will help rather than generic and specific areas where you have done something.
That is what I'm trying to explain, that it is not some one area which is kind of
Or the
leading
biggest
to.
area, the top two areas, because so quantum तभी समझ में आएगा ना sir, and the quantum also. Percentage of revenue, how much from what to what it has come
One
down?
area where we have really tried to extract more value and not increase is the publicity spend. If you look at the kind of publicity spend that we had been doing earlier, you find that it has more or less remained constant or has slightly decreased.
Okay.
So one would be that area. Second area has been the kind of efficiencies which we have been able to get within the plant. Efficiencies is not by way of expense kind of reduction only. It is the kind of output that we are able to generate with the same amount of resources. That has gone up tremendously both in the sanitaryware as well as the faucet plant. How it really helps is that earlier you were incurring all costs for gaining a certain amount of output. Now the same cost, slightly increased cost, is going for a much higher level of output. So essentially the kind of rejections which you were having earlier, if you look at the sanitaryware plant, you'll find that this is a major issue. Across, you'll find that whenever a new player is setting up a plant, in sanitaryware they find it extremely difficult to stabilize because of the fact that rejections are extremely high. You introduce a new product, you'll find that the rejections goes up and it takes time to stabilize. So we have been able to kind of bring out higher efficiencies over there, reduce the level of rejections, so that earlier you were incurring all costs and then throwing away the piece. Now you find that you are incurring the cost, but you are getting a higher output, so that your costs are getting spread over a larger number of units.
Understood. And the employee cost, sir, inflation looks to be 4 to 5% in the first half. Is that how to read for the full year? Employee cost inflation?
Typically, the employee cost, because for the staff, it has gone up in the range of 10.5 to 11%. For the workers, we find that it will be in the range of 5%. But we are anticipating a wage increase to happen in the second half. So that should take it for the whole year to be in the range of, let's say, 7 to 8% if that happens in this year.
Okay, 7 to 8% for the full year, the entire wage bucket.
Correct.
All right. This really helps, sir. Thank you so much for the clarification and best wishes.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. Due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for attending this call and showing interest in Cera Sanitaryware Limited. Should you need any further clarification or would like to know more about the company, please feel free to reach out to me or to CDR India. Thank you again for taking the time to join the call. Thank you and bye.
Thank you. On behalf of Cera Sanitaryware Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.